How are you doing, buddy?
Doing great. Housing. Always a lot going on.
A great piece on the New York Times last week. So that was awesome, buddy. Good job there.
Yeah, well, thank you for putting me in touch with the reporter.
Dude, she texts me after she's done with you and she says, "Who is this guy? He's like the smartest guy I know in housing." I'm like, "Yes, he is. He is amazing." So, Lance, thanks for being here. Appreciate you. Everyone, we've got Lance here. Lance, I'm gonna go ahead and give you a little shout out so people can join your newsletter. A lot of the housing information I get is now directly from Lance. So I'm going to give everyone the link to sign up for his newsletter. He's got a free version of it, but he's also got a paid version. It's ResiClub. He runs it. He's a co-founder, chief editor. If I were you, I would pay for the whole year. You get amazing information. You can use it for your clients. You can use it just to stay in the loop as to what's actually happening with real data. And he does a great job just simplifying it for us. I think that's, Lance, I think that's your gift, man. You simplify it for us, which is really nice. This is brought to you by Y Realty. I know a few of you noticed I made a change. So Y Realty is the change. It's our brokerage now, and we're expanding out of California. So if you have questions about that, let me know. We'll put up a link there. But Lance, where do you want to start when it comes to the national housing market and where we're at and where we're going?
Yeah, I think it might be good real quick, and hopefully I can share my screen to go through some of this. I think it
Yeah.
might be quick to real quick just talk about where we are in terms of the cycle with the Fed, and then we jump in and kind of talk about what's going on in the current housing market and how that kind of varies across the country.
All right, let's do that, man. Let's do that. And then
Okay.
are you able to share your screen right now?
Let's see. Can you see it?
Got you.
Okay, awesome. So this chart is what I call one of my dual mandate trackers, and the Fed has a dual mandate to maximize employment, and then there's price stability. And since March 2022, the Fed has really been focused on the price stability side of their mandate, right? Going after inflation. It had peaked at around 9-8% year over year in the summer of 2022.
Mhm.
We've since seen that significantly decelerate. Inflation's still going up, but at a lower rate. And that's gotten down to now 2.6 as of this week. And at the same time, we're now starting to see the unemployment rate slowly tick up. The unemployment rate's not to a high level at 4.2%. Historically, a lot of economists would tell you that's full employment, right? And so if somebody told you that the unemployment rate was 4.2 and the inflation rate was 2.6, and they had told this to an economist 5 years ago, they would think that we would be at the start of a Fed rate hiking cycle, not at the cutting side. But the big thing there is that inflation has decelerated and that the unemployment rate is now starting to tick up. And it's gone from 3.4, the cycle low, to now 4.2. And so historically, when you see that type of a move up in the unemployment rate, historically, it's usually led into recessions, but it at least marks a cooling in the labor market. And so now the Fed's going to take that serious. We're at the cycle high for the Federal Reserve's short-term rate. And so now they're going to start to cut that. And so where does that take us for, interest rates over the next year? We'll have to wait and see how the unemployment rate goes. If that starts to move up quicker than expected, then rates are going to come down more than expected. If the unemployment rate kind of holds a little sticky and the inflation rate is also a bit sticky, maybe rates don't come down as much as expected. But the big thing for interest rates is that while the Federal Reserve sets the short-term end, the long-term end can get ahead of all of this. And so we've already seen the 10-year come down a bit. We've seen the 30-year fixed mortgage rate come down from this year's high of 7.52, according to Mortgage News Daily. And as of yesterday, it was 6.15. So that's a 16-month low right
Yeah.
around for the average 30-year fixed mortgage rate. And we're also seeing the spread between the 30-year fixed mortgage rate and the 10-year treasury yield start to narrow a bit. That really topped out in the Mortgage News Daily data series at 3.3 percentage points, which is a huge spread, very high. And that's
Lance,
now down to about 2.4 percentage points. And why that matters is if the spread were to normalize overnight, we would be looking right now at about a 5.5, 5.4, even 5.3% average 30-year fixed mortgage rate. And so while a complete normalization there isn't guaranteed to happen overnight, it's likely that we're going to continue to move down there. Mark Zandi, the chief economist at Moody's Analytics, we've been talking about this for a while, and his view is that, and he's had this since 2022, as we got near the cutting part for the Fed, once they were actually going to start to cut, the spread would narrow. And then once they actually were cutting, he believed that there would be more narrowing of the spread. So we'll have to kind of wait and see. And so I just kind of wanted to cover that because I think that's really big for mortgage rate. And especially what we've seen in the past few weeks, this move down. And as in his next week, once we get this first actual cut from the Fed.
Can you explain really quick to everyone where the spread comes from and what that really is for those that are wondering?
Yeah. So historically, there's about, and I don't know if, I have this chart handy. There's historically, and let's see if it works. There's historically about a 1.75 percentage point spread between the 30-year fixed mortgage rate and the 10-year treasury yield. And they usually move in sync, but it's certain times when there's more volatility in the market, like we saw over the past couple of years, because one, the Fed was a huge buyer of mortgage-backed securities during the pandemic period, right? They were just buying them up. That helped to drive mortgage rates even lower. And the spread actually, it got down to 1.38 percentage points at the low. And so as the Fed was consistently buying these mortgage-backed securities, they were the buyer of that asset. But once inflation took off, they stopped buying. And so the buyer of that asset pulled back. And so the yields moved up because nobody came in and was buying the asset like the Fed was. Then the other part is a lot of these mortgages that have come out over the past couple of years, there's a view in the market that at some point they will refinance, right? So there's the prepayment risk there as well. And so that, and then coupled with some volatility that's, in the market because we're going through this Fed rate hiking cycle, all three of those things kind of played together to expand the spread. And the one other wild card there is that when Silicon Valley Bank failed, and then there was that shock very briefly in the financial system, that's when the spread got even bigger, right? And so since that point, we've slowly been coming down for the spread.
Got it. Okay, so now let's go with the assumption that mortgage rates are going to come down a little bit. We're seeing inventory now go up more than what we've seen over the last couple of years. And where does that place us as a nation as far as being able to purchase because rates drop and there's more to choose from? Or should we be worried that unemployment is growing and it could create a different scenario? Where do you see us in the next few months?
Well, let me find my national mortgage rate or my national inventory chart. I got so many charts, you kind of lose track of.
Well, listen, as people are watching this is all the stuff he sends out. So anytime he sends something great, I text him and I'm like, dude, this was amazing. I love this one. So this is all the stuff you get on ResiClub, and he breaks it down for you.
There we go. Okay. So what we've seen over the past year is that we have seen active inventory for sale on a nationally aggregated level start to increase, right? So we are at now in August, 900,000 single family and condos for sale across the country. And that's up significantly from the COVID lows of like 570,000 around this time. in August 2021, but we're still about 25% down from the 1.2, 1.3 million for sale before the pandemic, right? So we're increasing, but it's slowly taking time to get there. And I think on a year over year basis, we're up about 250,000 units. So that's actually some pretty solid growth. If we could sustain this into next year, and I think by around August, September of next year, if we sustain the current trajectory, we would get back to pre-pandemic. Now, why is inventory increasing? Well, the interesting thing is you're actually not seeing this happen because there's a lot of new listings. There's not. And actually, new listings are near historical lows, as you can see here with 2024.
Yeah.
So the reason that active listings are rising despite new listings not rising is just that demand is constrained, right? We have this huge affordability hit from all the rates moving up, from the prices, from the insurance, and then now some of the echo and some of these markets from property taxes. And so it's because homes are sitting on the market longer and taking longer to sell. And so I kind of think of active listings. Let me go back to my actives chart. This is kind of a lot like a car dealership, right? This is everything for sale at the dealership. And so if you roll into the dealership and there's very few cars for sale because everything's selling like hotcakes, it's probably going to be pretty competitive, right? And you're not going to get many incentives from the dealer. But if that car dealership starts to get, full, right? Fewer buyers are showing up. And that doesn't necessarily have to mean that there's a lot of factory deliveries to the lot. It could just be that things are taking longer to sell. And so if that lot starts to get fuller, more deals will come, right? And so that's kind of what the active listings are. And so active listings can both be affected from buyer traffic, right? And then also from what's getting listed. But right now it's rising primarily because there's not a ton, the buyer side has kind of been a little constrained.
Things aren't selling as fast. Does that include that chart right there? Does that include new construction as well?
It can get rolled into there. Some of these, like the Altos and the Zillows and I'm using the Realtor.com data series. They'll have some coverage for it, but also a pretty big chunk of the new construction market is off the market, right? Off market listing. And so that doesn't get rolled up into here.
Well, this can create a possible danger for us. By the way, guys, if you have any questions, put them into the chat. I'll grab them and ask Lance. But I'm concerned about, Lance, what you're just showing me there. This is what I was going to ask you, but you brought it up sooner. With inventory sitting there longer, and that's the reason our inventory is going up. With rates dropping, let's say they do end up dropping, like you said, 5.5 or even slightly lower, right? Depending on what happens. That could create a bigger danger because now we get into the territory of all these homeowners saying, hey, I'm not going to put my home on the market because there's no way I can get this rate. But now it's close enough to be like, hey, I'll put my home on the market. And then that could create a different market that I don't know that we've been talking enough about.
Yeah. And so if we started to see rates come down more, right, this data series could start to heal. And this is new listings. And right now, even though you're seeing active listings move up, there's still what I would consider a lock-in effect on the market, which is the churn in the market, somebody who's going to sell their home to go buy something else. Mm-hmm. That is the part of the market right here that's missing, right? We've kind of lost a chunk of that. There's fewer people who are like, you know what, I'm going to sell my home, go get something bigger or nicer. Because if they did it, well, one, a lot of them wouldn't qualify for that new mortgage rate, that new monthly payment. And then the other thing is, it's a huge shock to them, financial shock, to go from that lower rate, lower monthly payment to a much higher one. So if rates were to come down more and kind of get closer to 5.5, get under 5.5, I think you start to slowly get more of that churn back into the market. And I think to some people, that's a concern, right? Because they're like, well, that's going to bring a flood of sellers, right? But I think the important thing to keep in mind is that everyone who is locked out of the market from lock-in, they are a seller and buyer. They're both, right? And so if they're coming back into the market, they bring supply, but they also bring demand. And so I think that's an important factor to consider. Plus, if rates do come down, you also potentially, depending on where the economy is as well, if the economy is still holding stable in your market, you could get some more buyers also who are like, you know what, I can now afford it. I'm going to get in there. And so I think the industry is really rooting for the lower rate scenario because you potentially get more listings, potentially get more churn, and then also could, depending on how the macro environment goes, get more buyers as well.
I love that. All right. So now,
so real quick before we jump, you had pushed back on my chart saying, hey, maybe does it include all the new construction? Is that all the market? One thing to keep in mind is there is a pretty big chunk of the market that is off market, that's not MLS. And a lot of this is new construction, of course, but this is a look at the off market side, which doesn't get covered in the data series as well. And I've actually not gotten great data on this until recently. This is from Batch Service. So Texas and Florida, and of course, the markets that have more of that new construction, they're also the biggest places for off market.
Okay, thank you, man. There's a quick question by John. He says, do you have a section where you can break down the different parts of the industry, the housing market? So you've got like condos, single family residences, and so forth. Is there something like?
I do a little bit of that. So let me give you an example. I do my condo stuff more like quarterly, and it is really important right now. Let me see if I can find it. I might actually just need to look the story up.
Perfect, because it's also as you're looking, Lance, it's a shift I wanted to talk about too, because we've got like 3 different markets happening all across the United States, and one of those that I wanted you to show us was the condo market, specifically in Florida and in Texas.
Yep.
Which is a perfect opportunity for you to grab that.
Okay, so I did this story at the end of last month, and pretty much just talking about how Florida's condo market is passing through a correction right now. And despite the fact that most of the markets in Florida are still seeing year-over-year increases for single-family prices, condos down in 18 to 25 of the major markets there. And what occurred is that in June 2021, there was that Surfside condo collapse that killed 98 people in Florida. And after that, there was a bunch of new structural safety rules requiring more inspections, additional funds for repairs. And so you have all these special assessments, which they can be 6 figures, right? And the HOA increases. And it's really been most acutely on the older condos across Florida, and especially coastal, built in the 60s, 70s, 80s, 90s, right? And so I can do prices by condo and single family. And so here you see single family, this dot for Florida, blue, and then red is condo. And so condo is underperforming single family across Florida in 24 to 25 markets.
Damn.
And then everything from right here, this line 0, and to the left is negative. So there's 6 markets in Florida that are down for single family, but there's 8 that are down for condo. And all of these markets, there's greater weakness in condo. And so my theory here is, because if you look at this trend, it looks like condo's the weakest there, but there is a little bit of spillover happening where there's so much condo supply that it's causing weakness in the rest of the markets there, like Punta Gorda Villages, Northport, Cape Coral. And in some of these Southwest markets, there's some additional factors where you had Hurricane Ian that hit in September 2022, third costliest hurricane in U.S. history. There's been a greater pullback in pandemic migration to those areas. And then really the affordability is more strained there because prices just went up so quickly, so fast during the pandemic. I mean, Punta Gorda, I think home prices there were up almost 80%, almost double US.
Is that ground zero, man? Punta Gorda? Because this is like the 8th time I've seen it.
Yeah, it is. It's a smaller market. It's around like 200, 300,000 people in the metro. And there's also a lot of new construction there. I mean, for a market that only has 200, 300,000 people, they were building more homes than Pittsburgh, which has well over like 2.5 million for a metro.
Yeah, I remember.
So a good amount of new construction as well. And I had a professor recently who called me out and said that Punta Gorda wasn't still passing through a correction. And then we just got the prices yesterday, the new prices, and they're down another like 1.2 for the month over month, which in the indices that I use, that's a pretty big drop and beyond seseasonality. So
That's just month over month, right? That's not like year over year.
Yeah, and they're still down like 6 year over year, and yeah, definitely some weakness there. Actually, this map will show it as well. So this is condo prices across the country year over year. And you can always click mine and always see them interactive. I like to put in a lot of data. And then I like to keep it in context as well, where it's like, okay, yeah, Jacksonville is down 2.6 year over year for condo and down 4.9 from peak, but condo prices are still up 48% from March 2020. So I like to kind of keep some of that context in there as well with my data. And so this is condo right now, year over year. And then this is single family. And what you will notice is that around the Gulf, there's a lot more weakness. See the red in this top one for condo than single family. And actually, single family is almost up just about everywhere. There's been a little bit more give up in the seasonal window we're kind of passing through right now. But on a year over year basis, it's mostly kind of flattish to a little bit up. And the greatest upward pressure has still been around the Great Lakes, the Northeast, Southern California, and then some of the Bay Area.
So Lance, on that, if you could go back up to that map, because this was my next question to you. We understand, I shouldn't say we. Some of us understand why this is happening in the southern part of the country. But what some people keep on asking is what's happening in Southern California and in the Northeast that prices just continue to go up like that.
Yeah.
Because that's
so a word that I think people in housing should be a little familiar with. It's an economics term, but it's a really powerful one, and it's the word elasticity, right? And so in housing, demand is more elastic than supply. And what I mean by that is if rates move one way or the other, or some factors happen, buyers and demand can come in much more quickly or leave than supply. And supply, I'm really talking about the total housing stock, right? And so a lot of the housing stock in the US, it's still, 80 years old. A lot of it's 100 years old, 50 years old, 40 years old. It takes a long time to move the supply in the US, right? So during the pandemic housing boom, what occurred is that the demand side, which is more elastic, soared, right? So there was the ultra low rates, there was the stimulus money, increase in household formation as people were like, you know what, I'm working from home, I'm not staying with this roommate, I'm going to find my own place. And then also work from home arbitrage, where people could go from New York and go buy in Boise, could go buy in Austin, right? And so all of that caused a huge increase in demand, housing demand, but supply couldn't react to it, right? And so according to the Federal Reserve, to match the increase in housing demand that occurred during the pandemic boom, home construction in the US would have needed to increase 300%. We would have needed to go up to like 4 or 5 million housing starts. That's impossible. It's impossible. The supply chain can only move up a few percentage points a year, right? And the labor force can only move up a few percentage points a year. So what occurred, because supply is not elastic, is we overheated. Prices overheated. And just demand stacked on top of too little supply and then kept dwindling the active inventory, and we just overheated, right?
Yeah.
And so now I'm going to answer your question, which is, your question is, why is the Southeast and Southwest seeing more price give up, more softness than, like, let's say, the Northeast and Southern California? Well, the Northeast doesn't build many homes. So supply there is even less elastic. It's very inelastic. Southern California, they don't build many homes. It's very inelastic. Yeah. But the Southwest and Southeast, they've kind of caught up to it. They're a little more elastic for their supply, and they have increased home building. And as that new construction hits those markets, and builders do the things like the affordability adjustments, maybe doing the bigger buy downs, maybe cutting a little bit on price, money at close. Some of those things have caught the attention of just enough buyers to go over to new construction that the resale market gets put at a little bit of a disadvantage and homes take a little bit longer to sell. And so that active inventory builds more, right? Now, we are starting to see on a year over year basis, some of these other places that aren't as elastic for supply, they are starting to move up a bit from that pandemic floor, but it's going to take time, right?
Yeah.
And so I think that's kind of my big gist there. And then the other factor too is that some of those areas in the Southeast, Southwest, especially around the Gulf, Austin, Punta Gorda, Cape Coral, they've seen a bigger pullback in pandemic migration, right? Whereas in the Northeast, they didn't have as much of that pandemic migration unless you're really upstate, right? And so some of that pandemic migration is pulled back. But some of the areas in the Northeast and some of these bigger metros in the Midwest as well, they're still seeing a donut effect where, okay, maybe workers can no longer go from New York City and Philadelphia and Boston and go buy in Boise and Austin and Cape Coral as much, right? Because they need to go into the office 1 day a week or 2 days a week. But maybe since it's 1 to 2 days a week in the office, they're willing to go much further out into the exurbs and really far away that would be like an hour and a half, maybe even 2 hour commute. And so that seeking of relative affordability is created a bit of a donut effect in some of these Northeast markets as well. And Connecticut and New Jersey, over the past 2 years, they've actually been red hot, despite mortgage rates going from 3% to 7%. And I think a big part of that is that donut effect, where they're still seeing that work from home arbitrage, but instead of Boise and Austin and some parts of Florida, it's now just an hour and a half out in the exurbs.
That makes a lot of sense. All right, we got a couple of questions that are good. In fact, Lance, Mira's got a really good question that I think you could probably turn into a graph and blow it up. She says, I'm assuming, sorry, Mira, if I'm getting your name wrong or gender here, but which state looks like is great time to invest in real estate? Which state would that be if we're going to invest, or maybe it's multiple cities? Where do you think, based on your data, is an opportunity?
Yeah, so I think we've seen a really big rush of investment into a lot of pockets of the Southeast and Southwest over the past like 5, 6, 7 years. And I think that will kind of continue, right? That's where a lot of the growth in the US is. That's where, especially if we're talking in terms of like single family rentals, they're a little more easy on the laws there for landlords and stuff like that. But in terms of potential ROI, I would think that some of these markets in in the Midwest that have still some of that relative affordability, where some of them still kind of cash flow more despite rates going up as much as they have. Areas that I think are going to have a lot of growth, Columbus, Ohio, Indianapolis, I think those types of markets. In terms of like when you run the yields, you'll get Detroit very high, you'll get Cleveland very high, but some of those markets in the Midwest too, they can be a bit difficult if you're not a local as well. So, I don't want to push people too hard in terms of the investment opportunities. You really need to know the markets. But I do think because of the relative affordability, if we don't see, a greater give up on prices, right, than we already have, I think some of these Midwest ones could be attractive to some investors.
Yeah, one thing I'll add to that for Mira and everybody else, Lance, great answer. I would also look at this like a stock investment, like a company investment, where Charlie Munger, Warren Buffett go in and say, wait, is something happening here where that city is being depreciated a lot more than what it's sustainable long term? Like maybe it's really low, but it's artificial based on what's happening. So I think we have to give it another year or so to identify those. And let's say it is Punta Gorda, but they've got, and I don't know anything about Punta Gorda, but let's say they've got a great university. They've got companies, big companies that supply amazing jobs and hospitals, right? If that's there, and then you can then calculate and say, oh, wow, look, the future of Punta is probably going to go back up. Everyone's just freaking out right now because there's situations with the condos and other things. And these certain ones could be massive opportunities. But again, I don't know those areas. So you guys would have to do your homework on your own. Adam's got a good question. Thoughts on climate refugees increasing demand? That's different, Lance.
Yeah, that one's a little bit out of my wheelhouse, but I do think that the climate risk and what you're kind of seeing in the insurance market, it's having an impact on the housing market. Now, when you look at insurance, a part of it is because of increased climate risk in some of these markets. But the other really big story, and this is actually the bigger story the past 2 years, is that there's an echo of the pandemic housing boom that's occurring in the insurance market. And so home prices in a lot of markets went up 40, 50%, right? The cost of new construction went up 40, 50, 60%, right? So the cost of replacement has gone up dramatically for housing, right? And so that's hitting the home insurance market. And unlike most markets, there's a lot of regulation in insurance, right? And these insurance commissioners, many of them are politically appointed. And so they've been slowing down this echo boom that's coming into the insurance market. And so that's still kind of playing out, and we're still seeing those insurance increases, and it's happening sporadically across the country. It's not happening all at once, but that's a part of the reason that even some of these markets that have very low climate risk, they've still been seeing on a percentage basis some pretty big increases in home insurance. And so I kind of deflected the question a little bit because I don't quite know, but I kind of leaned into the insurance part of it, which is a pretty big story right now.
Yeah, you gave us some good stuff. What about the rental market? Where are we seeing that?
Yeah, so the rental market has actually been pretty similar to the purchasing market, a little bit more weakness. But what we have seen is that the greatest softening for rents is occurring in the Southwest and Southeast, where they're more elastic for supply, right? And so a lot of multifamily supply was financed during the ultra low period of low rates in 2020, 21, into early 2022. And that supply has been hitting the market finally over the past, let's say 12, 16 months. And 2023 was one of the highest years in, I think it's like 30 or 40 years for multifamily completions since like the late 80s. And then this year is going to be even bigger, right? Some like RealPage thought it would be the highest for multifamily completion since 1974 when Richard Nixon was in. Wow. So a lot of multifamily supply has been hitting the market, creating a softening in particular in the Sunbelt markets. Now, as we work through those multifamily completions from the ultra low rate period, the view of many rental economists is that the market is going to begin to tighten up, right? And that those apartment rents will begin to rise more in 26 and beyond as multifamily completions kind of roll over from this higher period. And for single family, it's been a lot more resilient on the rents relative to multi. That's because, well, the single family market is just tighter, right? And especially on that entry level side of the market. And so there's been a lot more resiliency there, although a little bit of give up and softening in markets like Phoenix and Austin for single family.
I was surprised to see that more people were leaving Austin now than coming in, which was pretty nuts. I had never seen that before. I was like, oh, I thought that was going to continue to grow for the next few years at least.
Yeah. So I've seen some mentioning of that, and I know for a fact that Austin has decelerated in its inbound migration, but I haven't actually. I think some of this might be just the whisper mill working. I haven't seen some of the hard data show it yet. And
Well, I'm
Austin's
waiting for you, man. Let's
yeah. So
let's get
I'm
going.
still kind of looking into that. It might be true. But one of the things is with population data, and there are some great private sources out there, but with population data, it's very lagged because we wait on these government
Yeah.
providers like census. And so we're always kind of waiting for them to catch up, where we're just finally starting to get good data through like summer 2023. And here we are just a few months from 2025.
Very true. Very true. Adam Hayes says elasticity is a term I learned from Lance. Have used it many times since. When explained property, almost everyone has an aha moment. So thanks, Lance. Appreciate that. And good question here. Antonio, we don't know about the migration, but great question. Where do you see the market's getting a little tougher as far as inventory going up in the next year based on what you're seeing, right? Things can happen. But where is it going to be more challenging to sell your home if things
Yeah.
continue this?
What we've been seeing is the growth around a lot of the golf. So this chart here is showing active inventory for sale in August 2014 or 2024. Active inventory right now versus 5 years ago in pre-pandemic 2019. Everywhere that is super dark brown, active inventory is much lower now than before the pandemic. So think of it as like an inventory desert, where in Hartford, Connecticut, there are 1,100 homes for sale right now in Hartford, Connecticut's metro area. And before the pandemic, in August 2019, there was almost 5,000 homes. So from 5,000 homes to about 1,000 homes, right? So for every 5 homes for sale back then, there's just 1 home for sale right now. So they are still overheating, and you still see it on their prices as well. And that's despite rates going up as much as they have. Now, if you go into parts of Florida and over into Texas, some parts around the Gulf, including New Orleans, it's a different picture. And active inventory has moved up a lot more there. You can see that Dallas is finally back to pre-pandemic levels. Buyers have a lot more. They have a lot more power in Dallas than they did a couple years ago. San Antonio, there's almost 12,000 listings, up from the low of about 4,400 in 2021 and a little bit above August 2019. Is parts of Colorado, same thing. Denver's actually increased really fast over the past couple of months. Some parts of Idaho that saw a lot of the pandemic migration. Some areas in eastern Washington, some areas in Arizona that, and also some pockets of Tennessee as well that really boomed during the pandemic. And so I think a lot of this goes back to the story earlier, where some of these markets have more new construction hitting, right? And they also have a pullback in that pandemic migration as 2021 and that second half of 2020 and first half of 2022 get further into the rear view mirror. And there's a bit of a regional correction there.
All right, perfect. Nicole's got a great question based on what just happened recently. And I want to see how you answer this one. It says, how much trust do you put into data when, say, for example, the employment data gets amended or misreported by the government, and then they send revision months after the fact?
Yeah. So the important thing for me, and I'm not a macroeconomist, and I don't exactly understand all of the labor market data, right? But I think we can watch and see what the Federal Reserve does and what they're saying, and then the trajectory of the data. And so right here, this blue line, and I'm about a month outdated. I need to get it a little more updated. But what you saw over the past couple years is the labor force was growing actually pretty significantly, and the unemployment was still very low, right? And a big part of this boost in the past 2 years has been a migration increase. That slowly started to decelerate, and the labor force is no longer increasing like it was. But
Hmm.
what we're starting to see is unemployment starting to increase. And historically, and this is the number of people unemployed. And so while you aren't seeing a big increase in the jobless claims, the
Hmm.
number of people unemployed is increasing. Now, is all of that people losing their jobs? Some of this is the job market softening, employers just not hiring as many. And so as these new grads kind of come out of school, they're not finding work as much as they were the past couple of years. But nevertheless, the amount of people who are saying they are looking for a job and cannot find one is 1.3 million higher than it was a year ago. And so when that starts to increase, historically, it often leads to is a precursor to a recession, right? And so this, what we're talking about right now, this is what the Federal Reserve has been debating for several months. And some people in the Federal Reserve are more uneasy with this increase in unemployment, and they're a little more eager to cut rates more. Some of the other ones are like, you know what? Yeah, it's increasing, but maybe this is kind of a lagged effect from all this increase in the labor force, all the migration that's coming to the country. And it's just kind of taking time for the data to normalize. And oh, by the way, inflation's still not to target. So that's kind of the debate they're having. I don't
Hmm.
know. I'm not a labor economist, but we'll see what the Fed does at this next meeting or when they announce it
Yeah.
next week, and then what they do in the following months, and then also where these unemployment numbers go, and then what these revisions look like. But I agree with the point that was made that most of the revisions that we've seen have been to weaker employment and over the past, really, I think 12 to 16 months, it's been going
Yep.
on.
It is interesting to see. All right, guys, I put up the link to Lance's newsletter, ResiClub Analytics. All of you should subscribe. It's free. I, in fact, think all of you should pay for the data. It makes us smarter if you take time to read it. Nicole says thank you, Lance. And obviously, this one's brought to you by Why Realty. It's a brokerage. I just opened. If you want to know more about it, I put up the link there. It's a type form. So go ahead and go click on that. John's got a great question for you as we here come to an end. Lance, if you got any questions, dump them in, guys. John says, can you ask Lance if he foresees any change to the typical real estate selling season starting in and around April, potentially being moved forward with interest rates dropping?
Yeah. So one thing that I think we've kind of seen a little bit that I've been watching is to see how the past couple of years have affected seasonality. I think the seasonality is changing a little bit where things have kind of come up a little earlier over time. Maybe I'm wrong, but that's kind of what I'm seeing in the data. But if we do see rates come in even more and they hold here for duration, then I think as we kind of move closer to that peak seasonal period, that's when, okay, the people who are like, you know what, I've been wanting to sell and go buy something else for the past couple of years. Rates have kind of come down for a bit. They look like they're going to stay here. And oh, by the way, I keep hearing about rates going lower. So you know what? I'm confident enough. I'm going to list my home, go buy something else. And for those folks, because they're going to be churn and they've kind of been churn sitting on the sidelines, they might
Mm-hmm.
jump into the market a little sooner, right? Because they're going to do two
Yeah.
transactions, sell and then buy, and that's kind of been what's been on the sideline. So I think it's possible. We do kind of need to wait and see where the market goes, because the other side is while there is some of this pent up churn for the market, there is still this affordability strain that's on the market, and even as rates come down, that's still kind of here, right?
Yeah.
And it's still at play. So I think these forecasts that are looking at, and Ivy Zellman has it as, and she said this a while back, that she thinks existing home sales have bottomed, but it's going to be a slow grind to get up. I think that makes a lot of sense. And if you go back and look at the 80s, late 70s into 80s, we topped out for existing home sales at the end of the 70s. And it took 13 years to recover the peak, right? Now, once we got off the highest period of mortgage rates, which was 18% in 1981, we did start that recovery for existing home sales. And there was an initial bounce, But then from that point on, it was really a slow grind to get the existing home sales back up. And it took 13 years from the one peak to the next. Now, the peak this cycle was 6.1. And I think a lot of agents and people in the industry would just be happier to get closer to where we were before the pandemic, that 5.3 million existing home sales.
Yeah.
And maybe, that 6.1 in the pandemic period, that's an outlier. That's going to
That
take
was
a really
nuts.
long time to get to. Yeah.
Yeah. What do you think we end up this year? Like low fours?
That's where we kind of been in a trajectory for. Yeah.
Yeah.
Now, at the end of the year, if we get, rates coming lower, some of these seasonally adjusted numbers might be a little higher than 4.0. But for the total year, that's kind of where we're heading for total existing home sales is low fours.
I'll tell you, John, to add to what Lance said, I also think depending on what state you're in, if you're going to have hard winters, you're going to have significantly less people purchase or sell during those times just because they just can't. And in places like Southern California, Florida, Texas, those areas, if rates do drop, then you may see more activity in those areas sooner. And then in those other areas, you'll see as soon as it starts clearing up and they're able to normally do the things they do, like you said, March, April, I think you'll start seeing an uptick there. Guys, we're going to do this quarterly with Lance. He always is up to date on everything. So Lance, we appreciate you, man. I'm a real estate agent and I look forward to your emails daily. So thank you for doing what you do.
Yeah, Tristan, thank you so much for having me. And thank you for everybody taking the time to look at some of these charts. And if you want to get more data from me and more of my stories, go to ResiClubAnalytics.com and put in your email.
Perfect. I did put that up there. Everyone, let's give Lance a thank you or a high five here in the chat. We had a couple hundred people on Lance watching and then on Facebook. So everyone loves you, buddy. Thank you. Keep on doing a great job.
Chat soon.
Thanks, everybody.